Imagine this. You've worked hard for years, and finally, you save $20,000. It's sitting safely in your bank account. One day, you open an investing app, you look at the stock market, and a thought pops into your head. What if the market crashes tomorrow? So you close the app. You decide to leave the money in your savings account, earning about 3% a year. It feels safe, but here's the problem. Inflation is rising at 6%, which means, quietly, invisibly, your money is losing value every single year. You feel like you're protecting your money, but in reality, you're slowly getting poorer. Now, if that sounds like you, this video might feel a little uncomfortable, because today we're going to talk about something important: why middle-class people fear investing, and why rich people don't. And the surprising part is this: it has almost nothing to do with intelligence. It has everything to do with psychology. My name is Mike, and I spend way too much time thinking about how people build wealth, and more importantly, why most people don't. Now, maybe you're someone who works hard, you earn decent money, you try to save consistently, but when it comes to investing, you still feel a little nervous about risking it. If that sounds like you, make sure to hit the subscribe button and give this video a thumbs up if it helps you out. Because here's the thing: the biggest financial difference between the middle class and the wealthy is not income. It's their relationship with risk. And what most people don't realize is this: avoiding investing might feel safe, but in reality, it's one of the riskiest financial decisions you can make. Let's start here. Most middle-class families grow up learning one core lesson about money. Don't lose money. Save it. Protect it. Don't gamble. Be careful. And on the surface, that sounds responsible. But here's what most people don't realize. Investing is not gambling. Let me explain. Imagine you leave $50,000 in a savings account, earning about 3% interest. After 1 year, you make around $1,500. At first, that sounds pretty safe. But now consider inflation. If inflation is running at 6%, your purchasing power actually drops by $3,000. So even though your bank account now shows $51,500, the real value of that money has gone down. In other words, you actually lost $1,500 in buying power. You lost money, just very quietly. You lost money safely. And this is where things get really interesting. Most middle-class fear is focused on visible losses. Rich people worry about something else entirely: invisible losses. Look, this is mostly psychological. If you grew up in a middle-class household, money probably felt limited. There was always a fixed amount. A paycheck came in, bills went out, and whatever was left had to be protected. So, when you finally manage to save $10,000, $25,000, maybe even $50,000, that money starts to feel sacred. It feels fragile. It feels like something you can't afford to lose. You start thinking, if I lose this, it could take years to rebuild. And that feeling is powerful. But now compare that to how wealthy families often think about money. They don't primarily see money as something to protect. They see it as something to deploy. To them, money is a worker. It's supposed to go out into the world and earn more money. But to many middle-class savers, money becomes something different. It becomes a trophy. Proof of hard work. Proof of sacrifice. Something you lock away so nothing bad can happen to it. And that single difference in mindset changes everything. Let's look at a simple example. Two people, both are 30 years old. Both have saved $20,000. Now they make two different decisions. Person A keeps the money in a savings account, earning about 3% per year. Person B invests the same $20,000 in a broad index fund, earning an average of 8% per year. Now, let's fast forward 20 years. At 3%, $20,000 grows to about $36,000. Not bad. But at 8%, that same $20,000 grows to roughly $93,000. That's a difference of about $57,000 from the exact same starting amount. Same age, same savings, just one different decision. And here's where it gets really interesting. According to historical data from the S&P 500, the average annual return over the past 90 years has been about 10% per year before inflation. After adjusting for inflation, the real return is still around 7% annually. But here's the surprising part. Most middle-class investors never actually earn those returns. Why? Because they panic. When the market drops, they sell. When the news gets scary, they pull their money out. And studies from Dalbar have shown something fascinating. The average investor underperforms the market by roughly 3 to 4% every year. Not because the market failed them, but because emotion did. This isn't really a math problem, it's a psychology problem. Now you might be thinking, Mike, what if the market crashes? Good, let's talk about that. Yes, markets crash. In 2008, the S&P 500 fell about 38%. In 2020, during COVID, it dropped over 30% in weeks. That's scary. But here's what most people don't realize. Every major crash in U.S. history has eventually recovered and gone on to make new highs. Every single one. The wealthy understand volatility. The middle class experiences volatility. Big difference. Wealthy investors expect downturns. Middle class investors interpret them as danger. One sees opportunity, the other sees threat. Let's get nerdy for a second. Behavioral economists like Daniel Kahneman have shown that humans feel losses about twice as intensely as gains. If you gain $1,000, it feels good. If you lose $1,000, it feels devastating. Same amount, different emotional weight. That's called loss aversion. And it's why middle-class investors check their apps constantly. It's why a 5% drop feels like disaster. It's why headlines trigger panic. Rich investors structure their lives so they don't need to react emotionally. They don't need the money next month, so short-term drops don't scare them. Time reduces fear. Here's something that might sting. The middle class relies on income. The wealthy rely on assets. If you rely entirely on your paycheck, investing feels risky because losing money feels like threatening your security. But if you already own assets, rental properties, businesses, stocks, equity, your mindset shifts. You're no longer trying to protect income. You're trying to grow systems. This is where it gets really interesting. The wealthy don't fear investing because their survival doesn't depend on it. The middle class fears investing because their survival does. Here's what most people don't realize. The first $100,000 invested is the hardest. After that, compounding starts doing serious work. If you invest $100,000 at 8%, that's $8,000 per year. That's money working while you sleep. Now imagine you add $10,000 per year on top of that. After 20 years, you're approaching $600,000 or more. At that point, 8% growth equals nearly $48,000 per year, almost a full salary from investments alone. The wealthy think long-term math. The middle class thinks short-term survival. Here's the uncomfortable truth. The real risk is not market crashes. The real risk is not investing, starting too late, selling during fear, living paycheck to paycheck forever. Inflation is guaranteed. Volatility is temporary. That's the trade-off. And wealthy people understand probabilities. Middle-class investors focus on possibilities. Could it crash? Yes. Will markets likely grow over 30 years? Historically, yes. Probability beats fear. Let me tell you about two friends. Both earned $75,000 per year. One started investing $500 per month at age 25. The other waited until 35 because he wanted to feel safer. At 8% returns, the early investor at 65 has roughly $1.5 million. The late investor has around $650,000. Same income, same contribution, just 10 years difference. Time is more powerful than courage, and fear delays time. So, how do you fix this? Here's the practical part. Build a 3 to 6 month emergency fund. That removes survival fear. Invest automatically. Automation removes emotion. Use broad, low-cost index funds. No stock-picking drama. Stop checking daily. Investing is slow. Think in decades, not months. If you zoom out, fear shrinks. Look, I get it. Investing feels uncomfortable at first because you're stepping into uncertainty. But here's the shift. Middle-class thinking says, I can't afford to lose money. Wealthy thinking says, I can't afford not to invest. And that small mindset shift changes everything. Because over time, money either works for you or you work for money. There is no neutral. So, if you've been sitting on cash waiting to feel safe, understand this. Safety is often just slow decline. Start small, start scared, But start, because the earlier you build the habit, the sooner fear turns into confidence, and confidence turns into wealth. If this helped you see money differently, hit that like button, subscribe, and I'll see you in the next one.